Welcome. My name is Len Lane, and I am the founder and president of Brokers for Life, Inc., and we are Dominion Lending Centers in Western Canada. The topic of our podcast will be about what we consider to be real-life mortgage solutions. Welcome back, everybody. My guest today is a long-time history with the mortgage industry in Alberta. To say he would be a legend, he would disagree with me, but he is. Gary Siegel recently retired from the Real Estate Council of Alberta, but a long time in the mortgage industry in a variety of positions, and we're going to talk about that today. So welcome, Gary.
Thanks, Glenn. Appreciate the opportunity. Hopefully your listeners will find it interesting.
Yeah, actually, I think I have a new thought for my fourth season. This is the start of season 4, where we're going to go and track down some of the other legends of the industry and see if we can get them to do the same thing. So it could be an interesting couple of months. Let's talk about your start in the industry. I didn't realize that it had been with CMHC.
Yeah, it was kind of interesting. I went to university at the University of Saskatchewan in Saskatoon and got a commerce degree and had a number of interviews, as most grads do, and I ended up choosing to work for CMHC. It was of the interviews I had, it seemed the most interesting, and they had a program back then they called their management training program. They hired university grads and put us through kind of a variety of different parts to get familiar with the whole industry, and it was their approach to try to generate future managers. So I liked that whole concept, and I started with CMHC, spent a few months in Kelowna in a small office, and then got transferred to Regina and had a variety of positions there.
Not more of the underwriting side of it, it was more of the actual day-to-day management of CMHC. Is that kind of what they did?
They sort of taught us everything, Len. I mean, back in those days, CMHC did some direct lending, and when they insured deals, they did appraisal. So we had an appraisal department, we had an inspection department for new construction, and property management, because we actually had a lot of direct loans from historic. And when they came back, they had to be looked after. So there was the whole issuing insurance policies to lenders. But on top of that, there was a lot of that. And actually, one of my first big jobs was one of the CMHC direct lending programs. We had this program called AHOP, which stands for Assisted Home Ownership Program. And CMHC was a direct lender. There was an income test that people had to meet, in other words, below a certain level. And the houses had to be built below a certain price point. Essentially, this will sound too good to be true, but CMHC actually gave grants for the down payment, insured loans up to 95%, or in some cases, in the early days of the program, they were actually the direct lender up to 95%. And then there was a subsidy based on the income that was also possibly available, so that a monthly supplement to help them with the monthly payments. And so one of the big jobs I had to start with was interviewing people to see if they qualified for that program.
Yeah, and they're still lending money, I guess, if with the multifamily projects right now, that they were doing that directly, but now it sounds like they've handed that off to the lenders themselves. Interesting that they would have their own appraisal and inspectors and things like that. I guess the size wasn't what it is today, and because they definitely have handed that off to someone else, and I can see that being something that they would have to do. So how long did you actually end up staying with CMHC?
Well, I was there a total of 7 years, and what I ended up having various responsibilities. My first job was an assistant in social housing. And again, we were direct lenders, and there was tri-party arrangements between municipalities and the province and the federal and CMHC on behalf of the federal government to build typically low-income housing, a lot of it directed at seniors in communities all across Canada. I was in Saskatchewan at the time, and we used to joke I'd be traveling along with the Saskatchewan Housing Corporation people because they were one of the partners. We drive into a town and we look at the number of grain elevators and multiply it by 2, and that's the number of units they qualified for. But so I did that, and then I became the manager of that department, and then ultimately the manager of the lending program, the insured lending program, and that's where again CMHC got really involved in trying to promote the creation of new housing starts, and the AHOP program was now being insured. There was still some grants and some subsidies that were involved to help people get into houses. The same sort of thing, income tested and houses priced below that. But on the other side of the coin, you mentioned multifamily. There was a program called ARP, which was a standard for assisted rental program. And there was a federal tax credit as well. So there was some subsidies to builders to build apartments in all kinds of communities, large and small. And there was also some CRA involvement, and it was called a multiple unit residential building, or MIRBs for short. I don't know if you were around.
I remember MIRBs, yeah.
But they were a tax break, and a lot of high income people were buying sort of shares in these apartment projects, and then they were getting tax write-offs. The challenge with that program was ultimately there was a disposition tax when they decided to sell their shares. Right. And once people started to get down the road a ways, they realized that it was good while they owned it, but when they wanted to sell it, there was some tax to pay, and the program lost its popularity. Yeah, but that was sort of a summary of my history at CMHC. So the last job I had there was the manager of that insured lending side of things.
Right. And that's funny because the first time home buyers incentive program is now people are selling those properties and not realizing that CMHC owns part of the profit.
Right. Yeah, I've heard that story too. Yes.
Yeah, we've seen a few of those in the last few months. So is that where you transitioned to the mortgage industry at that point, or was there something in between?
No, there was actually several stops in between. So the next stop, there was a company that formed. So this ties back to the CMHC appraisal inspection process and the new construction business. So when a builder wanted to build a house and have it an insured mortgage, and quite often back in those days, it was progress draws, insured progress draws. The builder would submit its plans and specifications and its proposed selling prices. And the inspectors would look at the plans to make sure they met the code. Then they would go out and do a site inspection to make sure the site and the building and so on fit. And then it would go to the appraisal department, and they would decide if the value was appropriate. Then it would come back into my administration staff. They would issue the undertaking to insure, the CMHC 530, it was called at the time. It was the form number, and it was an undertaking to insure. And then when the house started, there were 4 different stages when the builder had to call for an inspection, and they'd mail in this little green card, and then the inspectors would go out and inspect and so on and so forth. So having said all of that, that was a very cumbersome, slow process. And builders were looking for an alternative, and they got some various other organizations together who decided that maybe there was room for an alternative mortgage insurer. And MICC, which is Mortgage Insurance Company of Canada, was formed, and that was sort of the primary initial market. And they just did the inspections at random. Some of the processes were similar, but they did the inspections at random, and builders were able to they had to stop construction while waiting for those inspections. So this appealed to the builders a lot, and that was kind of the niche that MICC started out in. And they offered me the job as their manager for their Saskatchewan operations at the time. I think I was 29 at that point in time, and so I took over that job for a few years. And so remember the time frame starting in 72. So we're going further forward. And so we had CMHC as a mortgage insurer, then MICC formed, and then another one formed called Insmore, and then a third one called Sovereign. And then over the next few years, they realized the market maybe wasn't big enough for 4 insurers, and Sovereign and Insmore merged. And then later, Insmore and MICC merged. And that all was coming together right around the time we're now hitting the late 70s and early 80s. In the early 80s, we had this national energy program that the federal government introduced, and it created a huge recession. And interest rates started to soar. I can remember my first mortgage when I bought my house in Regina in 1973 was around 8%, and then the next renewal was in 12s or somewhere in there. And then right in around 1980, I had a renewal that came up at 19, and rates actually didn't stop till they hit 21 for a 5-year fixed mortgage. So there was all that going on. And in the interim, one of the other things that had happened is that whole subsidy thing on the assisted program went away. It was replaced by something called a graduated payment mortgage. Have you ever heard of a graduated payment mortgage?
No. That is one I haven't. I lived in Calgary, and I moved to Calgary in 78 or 79, I guess, we almost bought a house in 81 because everybody was turning in their keys. But the problem with that being that, interest rate cheap and houses weren't cheap in Calgary in 80, 81, like, by comparison to today, they are, I guess. But, but the rates kept going up. So we waited it out for a while.
Yeah, well, that's probably, there was lots of bargains to be had after that. So what happened in that interim, this graduated payment mortgage, instead of subsidies, it was just simply they found several lenders who were prepared to write these rather creative mortgages where your payment started below the amortized payment level, and it stepped up. So it would also be known as a step mortgage. And so every year for the first several years, I think 10, maybe even 15 years, your payment was guaranteed to go up by a certain amount every year. And of course, there's still a renewal that could happen in there as well until it hit its normal amortization. So that was the way of, getting people into affordability situation with buying a house without subsidies, because the government was starting to run out of money, I guess. And so, so MICC being kind of like favored by the builders, insured a whack of those. And in particular here in Alberta, there was a big builder in Alberta called New West. You may have heard of them when you lived here.
Yeah.
And New West, that's the Scurfield family. Ralph Scurfield was the head of New West. He was also on the MICC board, so there was a close relationship. And they developed some even more aggressive versions of that GPM program, and we insured them at MICC for them with New West's guarantee that if there was the difference between what we would normally insure and what we insured for them to help them move more houses, they would guarantee to pay that difference if they ever went to default. Well, as you know, New West went down.
Yeah, here as well.
and along with a lot of others, and the market crashed. And MICC didn't have the cash reserves to pay 100% of all the lender's claims. So they had this thing called option B, and they paid 20% of the lender would calculate their total cost of reclaiming a house, and MICC would use option B and pay them their 20%. And that's how MICC was able to survive, but the lenders really disliked that. So for many years after that recession ended, the only insurer that was being used in Alberta went back to being CMHC. So you went from 1 to 4 to 1.
Yeah. Interesting. Yeah, and you have to think about it. Your insurer only wants to pay 20 cents on the dollar. It's probably not a exciting thing for anybody, really.
Well, they got to keep the house. They did. The insurer did not take the house. The deal was, but the lenders didn't want to be involved in the disposition. There might still be losses because the property values had really cratered. Yeah. Since you were here in that time frame, you probably would recognize that.
Yeah. New West, I have a book called $100,000 an Acre that talks about the industry in Alberta. There's 2 volumes of it. One's called $200,000 an acre. Probably $1 million an acre now, right? New West adventure was a big part of it. I actually knew some people that actually worked for them here in Edmonton when that all happened. So actually, several of them started their own home building companies because they worked for New West.
Yes, there's been there's still a lot of, well, I think many of them have retired as well, but there were a number of people who got involved in other home build, either started their own or ended up working for other builders or land developers and so on. Because New West was a land developer, a builder. And then one of the other things they did back in those days, because they were so tied up in the housing industry and land development, they decided to move into the oil and gas industry. And they started, I think it was Voyager Petroleum. And of course, the cause of the recession, major cause was the National Energy Program. So while it was brilliant to think about diversification, it was the wrong level of diversification. So
and the wrong time. $9 oil was not good for anybody, right? So,
right, exactly.
as we've seen, more than once, unfortunately. So, okay, so then did that take you to mortgage brokering?
No, actually, well, yes and no. I actually moved from there to MICC was also insuring commercial mortgages back in time. So I got some experience underwriting commercial deals, and there was a company one arm of it still exists. Morguard, the company that I worked for was Morguard Trust, and we were a commercial mortgage broker. So yes, I went into mortgage broker, but not residential at the time. It was commercial. And I was still in Regina for a couple of years, and then I got asked to move here to Calgary in '88, just before the Olympics. So I think it was late '87. I was VP for Southern Alberta and Saskatchewan, and we were a year or so into my move here. We were acquired by Metropolitan Life, and they transformed the company. And that was the first time in my career I got a package. In hindsight, it was a really good financial move, but it was devastating. It was like I'd had a pretty successful career. At least I felt I was enjoying some success and getting offered these new jobs and these new positions. And then a new owner comes in and says, "We don't want you anymore.
Yeah.
We have too many VPs, and the other guys got more experience. So he's staying, you're going." And so I ended up doing commercial mortgage brokerage for another company called Midland Doherty, which was basically a financial planning firm that got ultimately bought by Scotiabank. And while I was just sort of getting that set up here in Calgary, MICC contacted me and asked me if I would like to come back to Regina, because they'd had some changes in management and they would like me to come back and take over. And Saskatchewan and Manitoba. They did even have one person here in Alberta that did the odd deal here and there. So I guess I was prairies at the time for MICC. I did take that job. There was a lot of transition in the mortgage industry back at that point in time, Len. And you might recall, having been around during that time, there was companies like Pioneer Trust out of Regina, and I'm trying to remember the one that was here in Alberta that got rid of Principal, it was. And so anyways, a lot of those companies ended up merging. And one of them was called, there was Guarantee Trust and Central and Eastern Trust, and Central and Eastern Trust and Guarantee Trust merged. And they also ended up owning MICC.
Yeah.
During that period of time, the trust company, the owners of MICC, ended up declaring CCAA, creditor protection. And while that was going on, MICC was still one of their most valuable, viable businesses. But because we had insured commercial, there happened to be a claim, which is a fairly large claim, that we paid. And that got the superintendent of financial institutions interested in looking at our books. And Central Guarantee Trust had the reserve money that MICC had put aside to pay claims, had a lot of Central Guarantee Trust assets in it. And the superintendent of financial institutions wasn't really happy with the quality of the reserves and said, MICC, you have to cease doing business. And so anybody who's familiar with the insurance business will know that you take your income into, you take your revenue into income over a period of time. So while we couldn't write new business, we were still a profitable company. We ended up, of course, anytime there's a company that stops getting new revenue, we had to cut back on our sales staff. We couldn't write new business, so why would you have sales staff? But we kept the doors open, looking for new capital. And you know, there was the odd claim here and there that had to be managed, and so we kept the staff around for that. And that's when GE Capital came to Canada and bought MICC.
Oh, and so, what year was that?
95, I believe. 95, I'm pretty sure it's 1995. So we've gone from 72 to 95 now, and I've described quite a number of changes that have happened in the industry.
That's cool, though, right? It's funny how, like, you know, somebody asked me the story about how I got to mortgages, and it's a long road that started with truck driving and owning trucks and softwood tariff and all of this, and changing to concrete and concrete to housing and housing to mortgages. But one door closes, another one opens, right? So
yeah, exactly. So what ended up happening then when GE Capital bought the company is they decided that they weren't satisfied being not a national company, and as they were trying to obviously get market share back, since it's been out of business for 2 years. Emily came along at CMHC as well, you know, which is the automated underwriting, and GE had an automated underwriting system in the States, and they thought they could apply it here in Canada, but it's going to take a fair amount of time. So we were running around trying to get lenders to send us business, and we were competing with an automated underwriting process, and we were underwriting deals up front. That was one of the keys, is that the way CMHC operated back in those days, you know, they would basically issue an undertaking to insure, and if they didn't like what the deal looked like when there was a claim, they may or may not pay the claim. Now, that didn't happen often, but that was sort of the niche that GE was trying to fill was, look, we underwrite up front. It takes a little bit longer, but we guarantee that there'll be a claim paid if everything you submitted to us was on the up and up. So we started to run some business, and then GE said, we don't want to be a local mortgage insurer, and we want to reopen Alberta. And they said, we think that our whether it was regional director or whatever at the time, we'd like you to be in Alberta. So here I am now. With MICC, I'd gone back to Regina, then they moved me to Winnipeg, and now I'm moving from Winnipeg back to Calgary in 1997 to reopen the private mortgage business in Alberta. And so there was me and one other person at the start. And as you know, today it's quite a bit different, and things have changed. And GE Capital decided to do some changes in their organizational structure, and they went public with some shares, and it became Genworth. Right. I wasn't there anymore. I had moved on from being the head of their operations for origination of mortgage insurance to their national training manager, and that was still GE at that point in time. Rebuilding that business in Alberta was extremely challenging, competing with the fast pace of CMHC insurance and the negative connotations of the private insurers. And do you recall the recourse on covenant issue from back then, Len?
Maybe not in those terms. So
no. Okay. So lenders could insure when they insured CMHC deals, and if there was a deficiency after a claim was paid on NHA insured loans, because it was under federal legislation, the province's legislation that prohibited lenders from suing if there was a deficiency after foreclosure, that prohibition didn't apply to NHA insured loans because it was a federal insurance program. Oh. And so some lenders started to do business with GE because we didn't have that ability. But of course, as an insurer, we kind of wanted that ability. And over time, the legislation was changed to, I believe it was in the early 2000s, to include all high ratio insured loans having recourse on covenant.
Right.
Because people were taking advantage of, there was fraud being created as a result of that, fraudulently obtaining a house and then knowing that it could go into foreclosure and you had no obligation after it went into foreclosure.
Right. And I think that was part of the jingle mail, as they called it in the early 80s. I'm sure that was part of it as well, where people would just drop off their keys and say,
oh, yeah.
Good luck with the house, right? Sort of thing.
Yeah.
We're not responsible.
There was a lot of stuff that went on in the early 80s, and this stuff now was happening in the late 90s. Now we're talking about having that history to deal with, the option B, and the only thing we had was that we guaranteed that we'd pay the claim and that we didn't have recourse on covenant, which really we didn't want to use as a selling point because we were trying to get it and ultimately did get it. But it was many years later that the legislation was changed in Alberta to recognize that. But so there was a lot of transformation in terms of what was going on in the background at that time. And it was really hard to get traction. And so ultimately, GE brought in a new manager, second package for my career. This one was actually, because it was really frustrating, Len. It was so difficult to build that business. And I don't know all of the different things that we tried, the different types of sales staff we hired, we just could not seem to penetrate the market. And so they went through 2 or 3 other managers, and eventually over time, systems changed and the marketplace warmed up. And now, the private mortgage insurers, there's 3 of them today, and they're doing good business, and just lenders like to have choice, and there's different reasons you will do business with one versus the other. But what ended up happening back then was I became the national training manager for GE, helping them. I built a whole bunch of different training modules: how to read financial statements, how to read credit reports. One of the lenders, for example, wanted us to train their people on how to use their system to send a deal to us. And so I got screenshots and I put a PowerPoint together and helped our sales staff help the banks. And that was kind of one of the things that we thought we could use. And actually was fairly successful in terms of gaining business by helping the banks understand more about us and more about the mortgage business, training their new lenders. And if you remember, that was a little bit before there was a lot of mortgage specialists. And so if you worked in a bank, you might one day do an RSP and the next day open a bank account for somebody and the next day do a mortgage. So training was really important, and we were offering that training, and it was my job to create those training modules for them for that year. Finally, to answer your question, in terms of how I got into mortgage brokering, this is now in the early 2000s. We're talking about the emergence of super brokers. Okay, and like we started off, there was, I believe, the first one might have been Mortgage Intelligence, and lenders were now starting to do more business with mortgage brokers, and in order to encourage that business, this concept of volume bonus was originated. So the more business you did with a lender, the more money you got paid. And so creative mortgage brokers across the country decided that they could build volume by amalgamating. And so the lenders' volume bonus incentive program played a large role in creating the first super broker, which I believe was Mortgage Intelligence, and then later Mortgage Alliance and Invis, and I don't remember which order that was. But that started right around the 2000. I'm still at GE at the time, but I found that I was getting kind of bored with doing the training thing, and this new super broker thing was intriguing, and Invis had an opening and offered me a job, and I wasn't to be a broker. I thought for a while, Len, that's what I wanted to do. I want to simplify my life. I'm just going to be a mortgage broker. So I went to talk to them, and they ended up offering me a job as their regional manager for, at that point, just Calgary. And eventually, over time, it grew, and I ended up being their VP for all of Western Canada at one point in time. Somewhere in that time frame, my former employer, GE, had gone from becoming Genworth to later on Sagen. So Sagen is really the current iteration of MICC, GE Capital, Genworth, and Sagen. So I was there for the MICC to GE timeframe.
Yeah, and that's when talking about the super brokers, I got licensed. I'll be licensed 19 years in September, and 2006, pretty much about the time that it was all starting to become. Some that were big in those days don't even compare at this point in time, right? The size of what the DLC obviously has become, a DLCG even bigger. But it made such a difference, I think. And yes, I loved volume bonus. The first time I actually got it, I'm going like, this is great. I get an extra check every month, right?
Yeah, exactly. Yeah.
And it's funny how even that has changed, where it was a secret almost to begin with, right? A lot of brokers didn't know about it for quite some time, and then it would be then it became that. I think might have been even Resmore who did it first, where they put it all together and just came out as it's 110, right? we're not playing this game, or maybe even it was Montana. That's what it was.
Oh, that's a name I forgot about.
I know. Yeah. James and Jerry did that, right? Where they just said, okay, it's 110. We're not playing with this. We're going to write one check. We're not writing two, which makes sense, I guess, business wise, right? So the industry has changed a lot over the years. What do you think some of the biggest changes that you saw that made a difference? Obviously, volume bonus would be one of them.
Yeah. Well, there's quite a few things that happened during my stint, because I spent 15 years at Invis, and so first thing you mentioned, you didn't even know volume bonus existed. We did. I think it was something like some strange split, like 82-18. And we kept the volume bonus at Invis, okay? And that was common in the industry. So the 82-18 for your listeners, 82% went to the originating licensed person, the actual mortgage broker, and the 18 went to Invis, plus all of the volume bonus, which was, what would it be, when 10 or 20 basis points? I can't remember now. It was an extra 20, wasn't it?
It was, yeah. It ranges right now from 15 to 30. So
yeah, okay.
Yeah. So.
And that was the model. And so the mortgage brokerage were, providing a lot of training, and there weren't a lot of desk fees or anything like that, because there was a lot of the commission income that lenders were paying was going to the brokerage itself.
Right. Yeah.
And so that changed as you've mentioned over time. Now I haven't been in the mortgage broker origination side, as you know, my career ended up with the regulator, but my understanding is that there are people getting split at 97.3 of everything nowadays. And so you've gone from keeping 18 plus an additional 20 to keeping 3%. And so the way brokerages operate today is quite different than the way they were in 2000 and 2002 when I started. So that's sort of one significant change, is that what comes out of that is if the brokerage is going to survive, it has to have other sources of income. So there's desk fees and other sorts of, at Invis, for example, we decided to start getting into selling creditor insurance, which over time built up to the point where it was a regular cash flow for the company.
Right. Yeah.
And there's all sorts of different ways that brokerages have found ways to survive and thrive. But the commission splits would be one of the biggest differences that I saw change in terms of how mortgage brokerages operate. Now, you mentioned DLC and DLC Group, and that's another big change, is that what happened in my career at Invis is that there was a change in ownership. I was there for about 3 or 4 different changes in ownership. But there was a change in ownership, which usually means a change in management. And one of our senior people, who was one of the founders, and a name that you'll recognize, Colin Dreyer. Colin ended up not being with Invis anymore, so he decided to start Verico. Shortly after that, Gary Morris and his crew decided to start Dominion Lending. And the model that both of those people ended up following was to start offering higher splits in order to attract talent that was already experienced and not build from the ground up. In other words, taking new licensees and training them. And so that to me was, from my observation, the beginning of where the split arrangements started to change. It was based on the competition and the growth in the industry. Now, those two companies are large, substantially successful organizations today. And, Verico is Invis, Mortgage Alliance and Invis were, there was a consolidation, a purchase by something called the M3 Group. So that's the other side of the business. M3 owns Mortgage Intelligence, Invis, Mortgage Alliance, and Verico, if I remember correctly. And your group is DLC, Mortgage Center, and Mortgage Architects.
Yeah, and they just bought a smaller group in Ontario as well that was about 3 or 4 billion. But yeah, so it's and that's Chris Turcotte is running that now. So and strangely enough, we were Verico. We started at TMG, and I was just over 3 years when we became brokers. And by we was Margie and myself, of course. Different models. Verico was just a flat fee. So we paid X number of dollars a month. Obviously not as successful as a franchise that actually takes 5% off the top of the majority of us. I'm sure there's some that don't pay anything, but just because of the size of their individual brokerages. So it was that probably was the biggest change in this boat when I entered the industry. When I was at TMG, I had the good fortune. I made $1 million in commissions in the first 30 months, but volume bonus came very quickly to me. Right? So 95.5 and volume bonus, came within about 6 months of starting. Where I'm sure there were lots of people in earlier days that never saw volume bonus ever if if you weren't contributing to the volume, right? But definitely some changes that happened there. Obviously, technology has made some big changes in the industry as well. You already probably, when did you start with RECA?
In 2017.
2017, yeah. So before the pandemic, right? We're going to be like the Irish. They date everything by the famine. We're going to start to date everything by the pandemic. But it's, the technology that changed and got accepted, like big banks accepting DocuSign and things like that is something that was a huge change over the years and stuff like that. So you were kind of in the government side of it to begin with, and so now you're in 2017. You're back to being part of the government again. So.
Well, yes and no. Let me backpedal just a little bit in terms of some other changes that happened, because the volume bonus was the most significant change. But you might recall that the markets were really taking off in the mid 2000s. We had that financial crisis. Up until that point in time, there was a whole bunch of mortgage insurers thinking about entering the industry in Canada. And so we ended up having one other finally survive, which is today Canada Guarantee, and it's Canadian owned, but it came up as, it was part of one of the American insurance industries. And there was a few others that were knocking on the door, but because we had the financial crunch. What year was that, Len? The financial crisis? Was that? 2008. Yeah. So the market was, and I can remember having lenders coming into our office at Invis and doing their presentations. We now do 100%. We now have no income qualifiers. We now, and I can recall, so I started in this business in 1972. GDSs and TDSs were 32 and 40, and that was it. That was the qualification. Yeah. And now we're throwing all that out the window. We got, 40-some% TDS and no GDS requirement, 100% loan to value, no income qualifier. I mean, it seemed crazy, and it turns out some of it was. And the financial crisis proved that you can't throw all of the standard rules out the window and expect success. So we ended up with a fairly, I think, stable market today, with 3 mortgage insurers. Some more creative things that came out of that. We saw the evolution from all kinds of new government rules that came in, as you have to live with every day, and they continue to evolve. What happened with the evolution of the government rules? So we ended up with some alternative lenders that were established, and many of the lenders who do prime deals today also do alternative lenders, and they have a different name or whatever. And in 2008, that was just kind of coming of age, and then it all ceased after the financial crisis, and eventually it evolved again. And what also changed, which impacted my time at RECA, so it's all connected, was that the emergence of private lending, went from here and there type of deals to a relatively significant portion of the Canadian mortgage market. So government legislation changed because of the financial crash, which basically added to the creativity of the people who are behind the money, and all these new products. I mean, what do you have to offer today, Len, as a mortgage broker for almost any customer? You've got private deals, you've got alternate deals, you've got prime deals, you got variable rate mortgages, you got fixed rate mortgages, right?
There's it's not as varied as it was in 2007.
Right.
Because I always joke, because Accredited had a program called Slapshot. And Slapshot was, you had 15% down payment, you had a job letter, didn't have to have income on it, they would give you a mortgage, right? So yes, so some things had to change, and unfortunately 2008 took out, I don't know how many lenders did we lose, probably 20, 30 lenders out of Canada that were out of the States and stuff like that, right? So not a bad thing maybe in the bigger picture of things, but yeah, now so today, pretty much every lender has a B side of some kind, or they're a home trust, and that's all they do. Equitable, probably more popular on their. I don't think they had much success on their A side. They actually closed it down again and stuck with doing what they did best, which was B, right? Bridgewater Bank for many years too, same thing, right? Dabbled in A, but in all honesty, their basis of success was always in the B side market. So it's still there. It's a little more regulated than it was, which is probably not a bad thing. Private lending, pretty reasonable rates by comparison today than what we've seen in the past, right? The private lender under 10% is tells you that there's a lot of money that's sitting around that people want to get out and get into borrowers' hands, right? So we cut back the private individual lending a couple of years ago. You probably heard me say that before, but just because the insurance costs were starting to climb, and still are probably, because it was the individual lender who was complaining to the insurance, and not the actual borrower who didn't care. He got his money. That's all that mattered. Right? So those changes, I guess, were all part of that coming out of 2008 and 2009, where I had the good fortune. I was in Fort McMurray still, and literally the blip up there was like maybe 90 days, and we were right back to full bore, because oil was still up there pretty good and stuff like that. So,
sure. Yeah. Well, what happened as a result of that too was so GMAC came into Canada, and they were doing some of the high risk deals, being like a finance company, and they bought Mortgage Intelligence as a distribution network for their private stuff, their high risk stuff. And HSBC bought, I think it was Avco, one of the finance companies, and they bought Invis in order to be a distribution network for that. And of course, 2008 came along, and both of those two organizations decided that was not a viable business anymore. And so We ended up, as a bunch of employees, putting together some money and buying Invis from HSBC. And later on, we put together a little bit more money and we bought MI from GMAC. And it was, they just were out of the business and they had no use for a mortgage brokerage in Canada anymore. And so the latter part of my mortgage brokerage career, I was the broker of record for Invis here in Alberta as well as in Saskatchewan. And I was also management for Mortgage Intelligence. So I was actually managing two brands for a while in the latter stages. So then what happened after that was this consolidation that we referred to a little earlier. And M3 came along and they bought the company in late 2016, I guess it was. I was a shareholder. I was one of the people that put some money up. And so I had my money out and thinking maybe it was time to retire. And then, so to answer the question, RECA, I had been appointed by the Alberta Mortgage, under the old legislation, the Alberta Mortgage Broker Association got to appoint one person to their council, and they appointed me. So I did, you can do 2 3-year terms. I did 6 years in total. And then Pat Kelly, who had been president of AMBA around the same time, like he was president, then I was president, then I became past president, he became president again. Then I got appointed to council after my 6 years. Pat got appointed to council. Then he decided to become a politician and had to resign, and I filled in his last year. During that last year, the RECA admin said, well, several years ago, we created this compliance advisor position for the real estate, and it's been wildly successful. So we're thinking about doing the same thing for mortgages. And so rather than retire from the industry, I decided to throw my hat in the ring for that job and was successful. So that's how I emerged into the regulator. Now, you said government. RECA is a non-government organization. It might be thought of because it's a regulator, but it is an NGO. So I'm not working for government, but it's kind of, a lot of people think of it that way because it's a regulator, right?
Yeah, and owned by service, run by service, right? So Service
Right.
Alberta. But so that's not quite the same appeal as working for something like CMHC, I'm sure. So as part of that, you were very involved with the MBRCC.
Yes.
Mortgage Brokers Regulators Council of Canada. Is that
that's
right?
correct?
I got the letters right there. Another acronym. How did how did that come about? I think I know pretty well, but and what effect do you think it's having on the industry?
Well, that's actually an interesting topic. So as the council member, I used to go and participate in MBRCC meetings. So it was a sort of an unofficial gathering every couple times a year. I think it was called the Canadian Mortgage Regulators Group or something at that time. And then it became a little bit more official. And when I say that, it's more organized in 2012. I attended the whole time I was on council, and then as a resource once I joined RECA in 2017. And the intention was to try to figure out ways to harmonize mortgage broker regulation across the country, to share experiences, to understand the industry better, and try to be more consistent. It doesn't have any official power, though. I mean, you remember, so it's a bunch of different regulators from across the country getting together really now 4 times a year to talk about how we can do things more in concert with each other. The problem with having real success with that is that a lot of the changes that we'd like to see are embedded in legislation. And, we're doing a rules review, RECA is doing a rules review now, and it's, I think, 2 years in, and, all the consultations that have to happen and all the, the different meetings that have to be held to consider what changes should be takes a really long time. And so progress is being made, but it's extremely slow. And there's just some things that, are just, they get flagged for. If you are a mortgage broker regulator in Canada and you have an opportunity to have a review of the titles that you require, for example, is one of the things. or you have a chance to review your legislation around private lending. So we've gathered data and we've tried to show the differences between different jurisdictions on a variety of issues, errors and omissions insurance. You mentioned earlier how it's getting more expensive, and it's not a very big market. So we've been studying that to try to make sure that we understand how that is operating in the mortgage space and what a change in our regulation might do to that business and so on. So it's not ever going to have I don't think it has enough. It just simply doesn't have the power. Constitutionally, mortgage broker regulation is provincial jurisdiction. So it really is just a coordination of effort to try to harmonize as much as possible. There are some things going on right now in education where I think we might start to see some recognition of, if you said you're licensed in 5 provinces? 6, okay.
Yeah.
So if like they're working on trying to put together a program where if you take Ontario's requirement, you won't have to take Alberta's, et cetera, et cetera.
Right.
So I think we'll see some of those types of impacts, and the spirit is there. The mechanism to make it happen is political, and you know what that looks like. So, but I think that the organization does a lot of good work, and there's a lot of people within the organizations across the country that are well intentioned. The thing that I guess I probably had to offer was a bazillion years in the mortgage space, which most of them haven't had.
Right.
And so they're very reasonable, intelligent, well-informed people. But I was able during my time there to offer some additional on the ground experience on the mortgage space. So I think that the organization has evolved, working on a number of interesting projects to try to get that harmonization in place, which will be an ongoing project given the Constitution of Canada.
Yeah. I could ask him why we can't all be called mortgage brokers a long time ago, because it is. You can see it in every legislation. Manitoba, I'm a salesperson. Some mortgage broker in BC. At least Alberta and Saskatchewan are kind of the same. And of course, I really was in favor of the tiered levels in Ontario, where the level 1 you just deal with residential, level 2 before you can do anything with private lending. And then that next level, if you're going to run a team, you need to be that associate broker and then a principal broker, which is what I hold, right? So it's always interesting to see it unfolding. I'm not opposed to the course. I'm a little confused about the course we're doing in Alberta at the moment. Looks like there's 4 different options. I'm just going to do them all just to see what they all look like. So when my team asked me, right? I know that's the same look I have.
4 different options?
Yeah, it looked like there was 4 levels to that course or something like that. But anyway.
Well, there's 4 modules.
4 modules.
Right, yeah. But it's all one course.
Oh, is it all one course? There's a lot of stuff there then. They're catching up for not having done that course ever.
Right. Well, there's a couple of things. So that was part of my work at RECA before I left. Myself and Jared Morrison from Alta West, we looked at courses that have been offered in Ontario, for example. There have been competencies that were to be included in the Alberta course. There were back when, what was it, 2020, I think, or 2022, I guess, when Invis started offering. They wrote a course. They included some additional stuff on private lending, but not as comprehensive as what we felt was going to be required, given the emergence of private lending and the complaints that you talked about from the individual private lenders in particular, and the impact that had on errors and omissions. So there's a domino effect that was happening. And so the industry council here decided that, disclosure forms are in existence in all these other provinces, and they're not really reducing the number of claims. So maybe better education. So we looked at the competencies that were established for the Ontario course and others that had been around for a while, modified them to fit Alberta, added some things because, a license in Ontario doesn't allow you to administer mortgages, but some people who are involved in private lending do administer mortgages. And in Alberta, you can do both under your mortgage broker license. You can originate mortgages, you can administer. So we added a section on the mortgage administration and so on. So ultimately, that's how that course came about. Now mortgage brokers in Alberta have not had to take a continuing education course since 2015.
Oh, has it been that long?
Yeah, it has. Yeah, the broker of record had to take a course just a few years ago. So you would have recalled taking one, but not all of your associates had to take it.
I take so many of them, Gary, that I just didn't even pay attention. Margie just tells me what I need to do for the year,
Yeah, exactly.
and I go to take the course. I've taken so many courses from what is it, MBCAC or something like that. But I ran out. I've taken all their courses. So now after 19 years, they've got to come up with something new for me.
Right. Yeah. Exactly. Yeah.
But I didn't realize that was 10 years since we'd had to do anything. But yeah. No question that I'm not opposed to the continuing education because things change all the time, of course, right? And we're always seeing new things in the market, which is kind of what keeps me here because there's never a dull day in mortgages around here. There's always some new question. I've probably had two last week. I'm going like something on a title that I'd never seen. Somebody had registered something and it wasn't in place yet, but it was noted that it was there. And I'm going like, oh, I've never seen that before, right? So it's that kind of industry that's always evolving, I think, and the more education for the agents, the better, because and when people come out of the course and we hire and train a lot of new people, the question I ask them is, what did you get out of the course? And the answer has been the same for 15 years. I got 70 so I could get out and get my license. so that's a big part of it. So lots of years.
One of the other things that has changed in that time frame too, Len, is that in 2017 when I joined RECA and left Invis, we had basically one major platform for submitting deals, which was Filogix, right? And shortly after that, your group had been working on Velocity, and at the same time, Mortgage Alliance was working on Boss. And now I think there's 6 or 7 different platforms out there. I've heard Scarlet, I've heard Finmo, and so on and so forth. And so, we see technology evolving. And then you have the FinTrack implications as of last October, and you see that the technology has evolved to do a part of the FinTrack job, the whole ID verification thing, and so on. So yes, it's very interesting industry. It's always evolving, it seems, and there's a lot of creative people because it is an industry of self-employed people, and in order to survive as self-employed people, you generally have to be ambitious and creative. So I think that's one of the things that kept me so involved in, especially the mortgage broker industry. As I described my career to you and just giving you the highlights, most of my jobs were 3 to 7 years. Some I left by choice, and some I was given an opportunity to change, which I have no regrets looking back on how my career has evolved. I've enjoyed I wouldn't say every minute of it, but I've certainly enjoyed it a lot. And so my last 7 years at RECA turned out like I just decided to do something for 3 years and ended up being there 7, actually 8, because this is 2025, right? Yeah. So that's my second longest career.
I'm sorry. That's pretty good. So what does retirement hold for you?
Len, I have only been in the retirement mode since the 1st of July, and as you know, it's stampede time, and I've been invited. Fortunately, I've been invited to a few events to get to sort of see people, maybe some for the last time. And I've got a couple of young grandkids here in the city that are gonna spend some time with them this summer, and looking forward to hunting season in the fall. All of the things that I've done in the past, just more of it. Yeah. I don't think that for some various personal reasons, I don't think that I'm not going to be one of those retirees that travels the globe. So that's not in the forecast, but lots of things that I do, like, I'm still skiing. Hopefully this winter I've got my season pass again, and instead of getting out 6 times, maybe I'll get out 12. Right. Yeah, that's kind of what it looks like. For me, I have, and I know I hear this a lot about retired people, is that they think they have a list of projects that's going to keep them going for a dozen years, and after 2 years, they're all done their projects. But right now, my list is pretty long of various little things that I haven't done before because it's going to take a fair amount of time, and I've only had a few hours here and a few hours there. So I expect to get caught up on some of those projects, and then we'll see where life takes me after that.
Yeah, excellent. So Well, we thank you very much for your dedication to the industry. That's a long span of almost over 50 years, right? 53 years.
53 years, yeah.
Yeah, that's amazing to see the growth and the change in the country and in mortgages themselves. So again, thanks for your time today. Hopefully you get out on your bike some more as well. So that's good.
That's definitely in the plan.
Yeah. Thanks for listening today. I hope you found the information that we provided to be useful in your mortgage journey. And remember, you can always find our associates at www.brokersforlife.ca/associates. Have a great day.